This is Agriculture Today. We are joined now by Roger McEowen. He is our K-State and Washburn University School of Law professor that joins us twice a month for some ag law updates. He's joining us this week because we have many producers, actually, that are reaching retirement age for Social Security benefit purposes. And there's a lot of questions that surround that subject, Roger. So thank you so much for joining us today to answer some of those.
Well, good to be with you, Samantha. And yes, this is a big issue. And if we look at just the USDA statistics in terms of the age of farmers, there's about two-thirds of all farmers out there that are age 55 and up, and a significant chunk of them that are age 65 and up. So I think one of the things about estate planning and succession planning and legacy planning is Social Security benefit planning. When should I retire? When should I put retire. Let me back up on that. I put retire in quotes because do farmers really retire? Well, I mean retire in the context of when should I start drawing Social Security benefits. And what I like to tell people is, kind of with a little smile on my face, is, well, if you can tell me when you're going to die, I can tell you how to maximize your Social Security benefits. But so it's not an exact science, not at all.
Absolutely. And because of that, like we mentioned, there's lots of questions that resolve around this subject. And I feel like the first one is pretty much, what is a typical full retirement age for people today?
Well, that's defined by the Social Administration, and that's a key concept because once you attain full retirement age, your earnings don't impact your Social Security benefits, but they do if you haven't reached full retirement age. And that age used to be 65 for those born in 1937 or earlier. If you're born between 43 and 54, your full retirement age now is 66. And then it increases in 2-month increments each year to 66 in 10 months for those that were born in 59. So if you turn, for example, somebody that turned 62 in 2022, the full retirement age is 67. So it's tied to how old you are, but basically we can think of it as 67.
You mentioned, age obviously has to do with when you can start drawing these benefits, but what does that process look like once you reach that age?
Well, once you reach retirement age, we've got somebody that turned 66 this year, and so they're right on the cusp of full retirement age, according to the SSA. There's a monthly earnings limit of $4,330 right now, and that's for the months before full retirement age is reached. And then the point is, because if you keep working at that point in time and you're drawing benefits, your excess earnings result in a $1 reduction in your benefits for each $3 of excess earnings that you receive before you attain full retirement age. Now, for a person who hasn't reached full retirement age, benefits are reduced by $1 for every $2 of earnings over the annual limit of $19,506. That $1 for $3 reduction kicks in at $51,960 this year, and those numbers get inflation adjusted. So you have to watch how much earnings, and that's earned income. That doesn't mean certain types of passive rental income or royalty income, those types of things. But if you keep working and you're drawing benefits, you've got to watch that threshold because some of your benefits might be reduced.
Key to understand for sure. And also I feel like key to understanding benefits is the taxation of these benefits. And it can be rather messy. So on a federal level in and of itself, what does the taxing of Social Security benefits look like for many?
Yeah, messy is a really good word to explain this because this is really confusing. You could have none of your benefits taxed, or they could be taxed at a 50% level or an 85% level, depending on your situation. For example, if we've got a person that files their tax return as married filing jointly, they will subject half of their Social Security benefits to tax if the total amount exceeds the base amount. And so basically that's $32,000 for this year. It's $25,000 for a single filer. So once you get over that threshold, you start getting your benefits taxed. Then that 50% changes to 85% of your benefits being taxed once your earnings exceed $44,000 on a married filing joint return. Those are maximum percentages in theory. There is a complex formula that often results in less Social Security benefits being taxed than the maximum percentage. So what I was citing to you were the maximum percentages. Fortunately, the IRS gives us a worksheet to calculate that. That's in an IRS publication.
Absolutely, yeah. We'll link to some of these resources that we discussed today in the show notes of today's program, which can be found on agtoday.net. But then the taxation doesn't end there, Roger. Of course, there's also state taxation as well on a lot of these benefits. So I know that differs state to state.
It does, and unfortunately, it's one of those states that taxes Social Security benefits. In Kansas, if your federal AGI is $75,000 or less, you are exempt. But once you get above that threshold, your benefits are taxed to the same extent that they're taxed at the federal level. Nebraska also taxes Social Security benefits. For 2021, they didn't tax it for joint filers that had a federal AGI of $9,960 or less, and others with a federal adjusted gross income of $44,460. So you've got these thresholds in both Kansas and Nebraska before your Social Security benefits start to be taxed at the state level. But a lot of states don't tax them. We're kind of in the minority here in Kansas as well as Nebraska in having the states tax at least some of the benefits at the state level.
Yeah, understanding if you are in one of those states, key for sure. And then those thresholds, like you mentioned, very good to know. And then there's some other good information to know for everyone that's looking to collect Social Security benefits. And that's kind of these donut hole issues that we run into. Can you kind of explain those to us?
Yeah, we usually donut something we like. They're tasty, they're sweet, but they're bad when it comes to Social Security. And what this is, in essence, is we have two inflation adjusters when it comes to Social Security. We have a wage inflation adjustment up until age 60 because your Social Security benefits are based on your lifetime earnings. And so those earnings do get adjusted for inflation, but only up until age 60. But you can't start drawing benefits until you turn 62. And then once you are eligible for benefits, then those benefits become also inflation adjusted. That's the COLA, the cost of living adjustment that people are really familiar with. Well, if you fall in that age 60 to 62 category, you don't get a wage inflation adjustment on your wages while you're still working, and you're not eligible to draw benefits yet, so you can't get those. And the problem for people that are in that donut hole right now is there's high inflation, record inflation in the economy that we haven't seen in 40 years, 8 to 9%. And if they're still working, their wages reflected in their base will not be adjusted upwards by that 8 or 9%. So you're locked into where you were at age 60, and you're going to stay there. You're done with your inflation adjustment, and you can't be eligible for benefits until you turn age 62. That's what the Social Security donut hole is, and it's not very sweet, and there's nothing we can do about it. We can't plan around it. You're just born at the wrong time in terms of when inflation hit.
There's some specific considerations for producers specifically, so let's talk through some of those as well.
Yeah, a lot of do this because there's a tax benefit to paying wages in kind, but those wages, such as crops or livestock, they count toward the earnings limitation test because that earnings limit test includes all earnings, not just subject to Social Security tax. And, of course, we pay in-kind wages to avoid paying Social Security tax. Federal Farm Program payments that a farmer receives are not deemed to be earnings when we calculate each calendar year's earnings limitation. So that doesn't count. The only exception for that is the initial year of Social Security benefit application, because in that year, all of your FSA program payments are counted along with other earned income and your earnings for purposes of the annual earnings limitation test. But once you get beyond that, they no longer count. A lot of farmers also, when they get into retirement, they'll have cash rental income. They'll cash rent their ground out to somebody else. The cash rental income that they receive is likely treated as earnings, even though they might be getting a wage from their employer. So this would be those who cash rent farm ground to their employer. Now, that's particularly the case if the farmer is farming the ground on the employer's behalf. So that would give you a doubling up of the wage income and the cash rent income for purposes of the earnings test. A lot of farmers in Kansas have land that's in the Conservation Reserve Program. So if we have a farmer who's drawing Social Security benefits, whether they're retired or not, the CRP payments are not subject to Social Security tax. And there is a specific exemption in the code that was put in a number of years ago with respect to that. So we have some of those nuances that are specifically just to farmers.
Absolutely. And if producers are looking to retire anytime soon or they're looking at understanding these benefits further, who might be a good resource for them to reach out to?
A lot of tax planners do this too, but particularly on this area, it would be financial planners that you want to be talking to, your investment portfolio manager if you have one, your financial planner. But keep in mind, this is all kind of subjective. If you can tell me how much you plan on making in retirement and how long you're going to live, then we can get you a good plan in place. But other than that, it's just basically knowing what the rules are and trying to figure out what might be best for you, knowing that it may not actually be best for you because we can't control all of the factors.
Absolutely. And when we talk about farm succession and things like that, this is a conversation that's often missed out on. But when it comes to planning for this phase of life, is it always better to start a bit earlier than waiting till the last minute like some might find themselves in now?
Well, I think so. Integrate Social Security benefit planning in with other retirement planning, succession planning, estate planning goals and objectives. I think we need to view it as part of the package. And often I find that it's forgotten. We just kind of, well, there it is. We'll just throw it in here. But maybe there's some optimization planning that we can do and integrate this along with other concepts that we're doing from an estate planning standpoint to try to maximize the amount of income in retirement. So a comprehensive approach is always what I suggest.
Roger, I know you recently wrote an article about this exactly on your blog, so I will link to that in the show notes of today's program, which can be found again at agtoday.net. But Roger, as always, thank you so much for your time.
Well, thank you, Samantha.
Absolutely. Once again, that was K-State and Washburn University School of Law professor Roger McEowen. We will be back with more ahead on Agriculture Today.